Remember, the audit of public companies is governed by the Public Company Accounting Oversight Board. Auditors of public companies should report on financial statements and internal control over financial reporting. Based on the provisions of PCAOB Standard Number 5, the audits of internal control and financial reporting should be integrated into one report. Let's go over Section 404 of the Sarbanes-Oxley Act. 404A requires an annual report filed with the SEC to include an internal control report. In this report, management acknowledges responsibility for establishing and maintaining adequate internal control. It provides an assessment of internal control effectiveness at the end of the year. Section 404B requires the CPA firm to audit internal control and express an opinion on the effectiveness of internal control. This is required for companies with a capitalization in excess of $75 million. Management's report on internal control must state that it is management's responsibility to establish and maintain adequate internal control. Identify management's framework for evaluating internal control. Include management's assessment of the effectiveness of the company's internal control over financial reporting as of the end of the most recent fiscal period, including a statement as to whether internal control over financial reporting is effective, and include a statement that the company's auditors have issued an attestation report on management's assessment. Here is the standard integrated audit report for a public company. Notice some of the differences between this report and the AICPA's audit report for non-public companies. The title is Report of Independent Registered Accounting Firm. Firms must be registered with the Public Company Accounting Oversight Board to audit a public company. Auditing standards generally accepted in the United States of America is replaced by the standards of the Public Company Accounting Oversight Board, United States. We continue this on the next slide. This is an integrated audit report. The report on internal control is combined with the audit report. Here it is. Certain internal control deficiencies are classified as a significant deficiency. This is a deficiency in internal control that is less severe than a material weakness in internal control, yet important enough to warrant the attention by those responsible for the oversight of the company's financial reporting. A material weakness is a deficiency in internal control over financial reporting, such that there is a reasonable possibility that a material misstatement of the company's financial statements will not be prevented or detected on a timely basis. Auditors are required to communicate both significant deficiencies and material weaknesses to management and those charged with governance, the board of directors. If a material weakness exists, the auditor should issue an adverse opinion. If a material weakness existed during the year, but was corrected prior to the as-of date, the auditor should test the new system, and if eliminated, they can issue an unqualified opinion. Here are other communication requirements. Communicate in writing to management all control deficiencies noted during the audit, regardless of severity. To the Audit Committee of the Board of Directors, communicate material weaknesses, significant deficiencies, and that all deficiencies have been communicated to management. And to the Board of Directors, if the auditor concludes that oversight of financial reporting and internal control is ineffective, this must be reported to the Board of Directors. After the existence of a material weakness resulted in an adverse opinion, management may eliminate the weakness in the next year and engage the auditors to report on whether the previously reported material weakness continues to exist. The engagement is focused on the controls relevant to the particular material weakness, and if they determine that it no longer exists, they may issue an unqualified report indicating that the material weakness no longer exists.